Hi, everyone. Thank you for joining this session today on automating intercompany to refocus capacity. Before we begin, we want to ensure that you're able to navigate yourselves through today's platform. So for any questions, please submit them via the Q&A chat on the right-hand side of the screen, and someone from our BlackLine team will respond to you. I'm David. I've been a chartered accountant for coming on 10 years, but spent most of my career in technology, in product management. In that role, I helped with the development of cloud-based solutions for accounting and finance. And that required me to focus on manual elements of their day-to-day processes and how to improve them through automation. This led me to BlackLine, where I now help customers understand how they can experience all the advantages that modern accounting now offers them. My goal is simple: to help shape your work so that you can focus on what's important, and that's running a business. So why are we here today? I'd like to frame the session by starting with two questions. First up, this kind of looks like a lollipop or a piano, but what we're looking at is three major process areas. On the left-hand side, it's around the creation and approval of transactions. Then we move into the balancing and the resolution of open, pending intercompany issues. And finally, rolling all of your activity, the information up for settlement purposes, and finally clearing. And in speaking with customers as they start out their journey to modernize intercompany, the issue is usually more pressing in one of these areas. And that's a good place to start your journey, right? But importantly, it's the union of all of these areas that makes technology so powerful in transforming what is otherwise a pretty clunky manual process and into one that's more logical and automated. And secondly, how can you get to a place where creating, balancing, and settling intercompany transactions isn't such a big effort? As you can see here, where the burden of these accounting processes is something that you can finally forget about. In other words, turning intercompany's distraction into action. Now, individually, various intercompany issues like out of balances may not seem material and are of little value. And maybe that's why intercompany has not been so high on the change agenda. However, from a total governance and control level, these disparate problems can easily strangle an organization. All these issues add up to a drag on resources. It's a really inefficient use of those resources, and it's a compliance risk. But how does this impact the wider organization? Let's think for a moment about your key objectives. Today, you may want to accelerate digital and finance transformation. You want to improve supply chain resilience, and you want to return to growth. Aligning to growth needs nimbleness in your organization and agility in finance to reduce the time it takes for finance to synthesize insights from your data and influence action. That's really the role of accounting and finance. Like using the accounting brains of your operations to look out for growth opportunities, pricing strategies, and that kind of thing. So the value model that you see here on the screen is all about aligning accounting and finance's capacity to where you need the most value. But the thing is that we as accountants often spend too much time in risk and process. And while that's important work, it's not necessarily work of the highest value. So where we neutralize and mitigate risk and we optimize processes, we do so with as little human intervention as possible, which means we want to put a lot of things on autopilot that allows us to free up capacity to move up the triangle. And that's because your strategy needs to be anchored in the most up-to-date information. So you're nimble, you're competitive. And you'll see finally that capacity sits right in the middle because it's a critical driver, something we need to optimize so that we're resilient and able to nurture success. In the world of intercompany, manual processes are a drain to capacity and create unnecessary chaos. It's a big distraction. accounting and finance are held back trying to mitigate risks, as I mentioned earlier. It's a big compliance issue. One of the reasons is the uptick in mergers and acquisitions, ultimately making our multinational value chains more complex. And as we bolt on new businesses, we also inherit, we add their systems. So it's no wonder that transactions represent the biggest consumer of cost and time in accounting. In fact, the flow of goods and services across the internal network of a group often dwarfs external sales many times over, that you can see here. So how does that impact? What's the challenge here for accounting and finance? Well, in today's modern era, we're caught between the jaws of intense competition and regulatory scrutiny, and with finance grappling with a huge number of transactions that locks them away from the business. And the chaos that you can see here on the screen is work that happens on a deadline. It's often a mess of people, technology, process, reporting, communications that's all glued together with manual processes. So what we want to do is ditch the data mining, capture processes, the spreadsheets, and the never-ending tackle to resolve intercompany out of balances, because it's really a tedious approach that will burn you out and leave you out of the action. There are four main or key challenges of traditional intercompany accounting. First up is disparate technology ecosystem. So we touched on this a moment ago, that may arise through mergers and acquisitions. But what we're seeing here is multiple ERPs and subledgers. Other systems that sit in the technology landscape, like tax and treasury systems, that are very much involved in executing intercompany accounting, and non-integrated divisions that come through mergers. What we see when we talk to customers is entities typically trade with each other through subsidiary-specific billing and accounting systems. Some transactions, in some cases, might be agreed to over the phone or email. And when you do that, you lose important information and documentation, like the intercompany agreements, proper transfer prices, the currencies, and other appropriate taxes. Next up, we have big intercompany discrepancies, balance mismatches. So with investigations stacking up for the period close, it takes a lot of work to balance activity, and worse, companies can accumulate write-offs that may be material. We have process inefficiencies amidst changing regulations. In the intercompany world, we're having to comply with changing or ever-changing country by country tax regulations. And this can lead to non-compliant invoices and overall, non-standardized, undocumented processes. You would probably be familiar yourself, but the customers we talk to, they often rely on knowledge passed down by tenured team members, which is all too easily lost when they move on. So all of these challenges, they impact the ability to confidently transact and substantiate balances timely. This is a chart that really shows what happens, when we are held back by a lot of this tactical transactional work. We're stuck in the close process when it all surfaces, when it bubbles up. And when you're stuck in a close, you're closed to the rest of the business. Those strategic initiatives that we spoke about in the value triangle at the beginning, we aren't able to align to those. So how do we eliminate this distraction? Well, there's a critical path which really looks around how you automate the creation of certain transactions. And ultimately, this helps to prevent the mess that you find usually at the end of the month. Then how do we optimize processes in a way that allows us to balance the high volume of transactions and ensure that there's an automatic way of resolving any out of balances, unexplained amounts? So we eliminate those out of balances when you come to consolidation. And then collectively addressing the final mile of intercompany, how do we settle and clear those balances to tidy up your books, to release cash, to reduce risk in FX. And ultimately, by bringing automation to the intercompany process, you're streamlining it, you're optimizing it, and you're creating capacity to do other things that matter most. So let's look at the product itself, the BlackLine Intercompany Hub. There are 3 solutions, starting with the creation of your transaction. So this is around the initiation, the approval, and the processing of the transactions and the creation of the invoices, whilst ensuring compliance with your trading hierarchies, policies, and the price list, right, that you usually set at the beginning of the year. There are certain transactions you do this with, typically that are more non-trade related or cross-ERP trade related. As we look to balance and resolve those, we're reducing effort and risk around that process. We're automatically flagging those trading pairs that create the variance. And finally, the netting and settlement. So empowering a better collaboration between accounting and treasury and the systems that they work with to clear off those transactions on a timely basis. By enabling a hub, what you ultimately have is the ability to integrate in a neutral way with your entire systems architecture, your ERP, general ledgers, sub-ledgers, tax and treasury systems. You have a central repository, a location that brings all of the activity together, all the support and documentation. You have intelligent workflows around looking at the discrepancies by nature and risk and type, and the appropriate teams or business champions to look at those, and a full audit trail, which helps with that part of the process, which could otherwise be very messy. So I like to say that bringing automation to intercompany processes help you unleash sustainable speed to cut through the noise that often happens at the month end, so accounting and finance can support the business more meaningfully. Some of the common outcomes as well is efficiency savings. There's no surprises there, but up to 60% gains, in end-to-end process automation. You're tax efficient across your tax structures, you're clearing balances, you're streamlining the governance of transfer pricing. Working capital, so efficient netting and settlement processes across systems. You're speeding up the movement of cash and you're reducing foreign exchange exposure risk. Efficiency or scalability around the onboarding of newly acquired entities, bringing sustainability to your processes to handle increased volume. And finally, of course, financial integrity. So the substantiation of intercompany charges, reducing balance write-offs, post-period adjustments, and having sort of a right first-time mindset around tax and transfer pricing as well. Here's one example of a customer that was able to leverage this create solution in the Intercompany Hub to reduce those imbalances by 30 times. In their case, was from $30 million to less than 1 million. So that was a significant bottleneck that we're able to overcome. And so as a final few slides, specifically on the BlackLine Intercompany Hub, is we unify your data, your systems, and your processes, which is typically your R2R, your O2C, purchase to pay processes. We unify your people, your tax, treasury, accounting teams. We break silos. We make data permeable across those systems silos and team structures. We help drive accountability, visibility, and collaborative working relationships. I'm really thankful that you've joined and listened in today's session at the Hackett Best Practices Conference. And we do welcome you to reach out if you have any further questions. Thank you.